Good afternoon, guys. Brett here with Directors. Hey, thank you for joining today's live. Wanted to talk today about self-employed borrowers and their income. Oftentimes I hear from self-employed clients where I just don't think I can be approved for a mortgage, or I know my tax returns are complicated, so I don't think it makes sense. And I'm always discouraged to hear that because I do a ton of loans for self-employed clients, and there are a lot of different approaches. So I kind of wanted to talk through some of the different approaches out there, maybe a few things that you might not know or self-employed clients might not know that can help them to get into a mortgage. So where I think we want to start, guys, is in a general mortgage, the number one goal is for an underwriter or a bank or a credit union, anybody to review the ability to repay. Ultimately, if a lender's lending money out, they want to see, does this client have the ability to repay? That's even some of the verbiage from the feds nowadays is, hey, is a lender properly analyzing the ability to repay? Kind of hence maybe what didn't happen in that 05, 08 era. So when we look at it for us, the most common way on a traditional mortgage for any borrower out there is looking at W-2s, pay stubs, or for a self-employed client, tax returns. So there's absolutely lots of self-employed clients that I look at and we analyze their tax return. Now, this may be for the last 2 years or just the last 1 year, depends on the loan program. And it's helping to go through and saying, okay, what is the cash flow in the tax return? Now, I like to highlight cash flow because just because on a tax return, you may have a lower AGI or adjusted gross income, we understand there's write-offs. Sometimes there's paper loss like depreciation. Other times there's expenses we can add back in. So our goal is analyzing what would the cash flow of the business be or cash flow of your personal income be for, again, that ability to repay that monthly mortgage payment. So just because you might show a negative loss, for example, I've had many clients, when we look at the bottom line number, that AGI on the front page of the tax return, it shows as a negative number or a very low number. But once we go through and say, hey, their business had a lot of depreciation expense, we can add that in. Or they had a net loss carryover from a prior year. That's great to have that tax savings. But that net loss carryover from 3-4 years prior, that doesn't affect today's cash flow. So we take that completely out. So again, we would do a proper cash flow analysis to see what is the real cash flow of the business and therefore what we can count towards qualifying. Again, typically can be significantly different than the bottom line tax number. So I like to highlight that because, again, that's been huge for many clients. Now, each business type is different. Whether we're in manufacturing, services, whatever that may be, there's going to be different things we can add or subtract back in. But that's going to be an important place for us to start. Now, I would say for most self-employed clients, we like to start there. Ultimately, if we can use the tax return, do a nice detailed cash flow analysis, and that qualifies us, that's going to help to have the most options for loan programs and typically present the best terms from rates and fees. Now, that being said, there are plenty of self-employed clients, whether it's been a couple of rough years. And it's always goofy that we're looking tax returns in past. It might not be accurate of what you are making today. Or if you have a business where you just take a ton of write-offs based on your business, that's IRS allowed. And even though we add stuff back in, it's just not enough. So there are many alternative incomes. So I love to talk to our self-employed clients about it because I don't want you to feel discouraged about the tax return. Even if we analyze it and it's not enough, that's okay. So the alternative options can be like a 1099 employee, just the 1099. We don't look at the tax return. We look at just that gross 1099 income with an expense ratio. That can be a massive difference for us to look at. We can do a P&L loan where we look at just audited P&Ls or a CPA prepared P&L. Once again, that's in the current year versus having to look back taxes. The other one we do a ton of is a bank statement loan. So again, remember, guys, our goal is to analyze the ability to repay. What's the cash flow? So for many, many self-employed clients, we will look at 12 months of bank statements or 24 months, whichever is more favorable, of their business. And the vision here is how much money is coming into the business. So for example, I had one recently where a guy's tax return showed minus 10 grand. Okay, we analyzed it and there was some add backs, but it wasn't that significant. Now we analyzed 12 months worth of bank statements and went through the gross deposits. Well, the deposits were averaging about $100,000 a month. So we looked at it and said, okay, we have about 1.2 million per year coming into this business and cash flow. Now we take an expense ratio. The standard one's about 50%, but that said, that leaves, even after 50% expenses, another 600,000 in cash flow annually or 50 grand a month that could pay a mortgage. So we could use 50,000 a month from a qualifying perspective and help that client buy a couple $1 million home. Now, remember, that same client had a negative 10,000 tax return. Now, part of that was he opened up a new branch of his office and there was viable expenses, but it's a great story I love to tell because so many clients would think, oh, I have a negative return. There's no way I can buy. Well, guys, if your business is doing well, just like this gentleman's, we analyzed that bank statement, we saw the true cash flow, and he absolutely has the ability to repay, and we can qualify that way. So many, many different ways to look at this with our ultimate goal of ability to repay and analyzing the cash flow. Now, in this case, it's kind of not that we need all those, it's kind of one or the other. We can either get tax returns and analyze them. If those don't work, then we could look at a 1099 if that's your case, or a P&L, or again, that bank statement. So that's 4 different style analyses we can do to help a self-employed client qualify. So within that, guys, we typically like to see a client in the business for 2 years. There's exceptions down to 1 year, so some stability helps. We're going to analyze those tax write-offs. So again, I know I'm kind of harping on that, but I think so many people assume because they write things off, they can't qualify. That's okay. We understand it's an IRS and an expense thing. It's not always a cash flow thing. So we're going to differentiate those two. Now within that, one of the biggest things we love to suggest is with any client, but especially a self-employed client, there's more analysis as we've been talking about. It's really, really good to talk about this early. So I love to help analyze this, put the plan together, run scenarios nice in advance to a client being out there actually shopping. I think this helps clients feel very good about what options they have, the terms they can put together, and feel very confident being in the market negotiating. So the earlier we can be involved, guys, and help to chat through details or what's the right way to structure something is going to make the process so much simpler for you, especially as a self-employed borrower. So feel free to reach out. Now, separate to that, guys, for any borrower, but again, self-employed clients we're always looking at the overall risk. So in addition to the cash flow analysis, the ability to repay, it's good that we look at, reserves potentially. How much cash do we have in business accounts or personal accounts or retirement accounts? That always is going to add another layer of confidence from a lender perspective. How much down payment are we doing? There's different tiers that give more flexibility. Where's our credit score at, or our credit history? So again, income, super important, or that cash flow analysis. But these other terms, it's that overall risk analysis of, hey, great credit score, great credit history, great reserves, good down payment. Hey, there's some flexibility over here because of that. So always think about all those, but most importantly, feel free to reach out early. We can help to analyze this and put that plan together. And again, as a self-employed borrower, know there are many, many different styles of analysis we can do so that you don't have to feel like just because a tax return looks this way or a bank statement looks this way, that you're limited. It's okay for us to use one of those different versions. So ultimately, guys, feel free to reach out anytime. If you have a self-employed client that's feeling discouraged, tell them that story. I love that story about the negative 10,000 tax return where we bought a $2 million house for the client. So it's an awesome structure. Feel free to reach out anytime, and we're always happy to help. Thank you.